This is System Trader Show, episode number 14.
Welcome to System Trader Podcast. Listen to interviews with top traders and find out how the most successful traders beat the markets and what are the secrets of their success. This is System Trader Podcast with your host, Jack Lempart.
It happens very often that we work because we don't see any alternatives. Our job may be annoying as hell. We may even hate it, but the reality seems like we don't have any other options. We have a mortgage, we have a family to maintain, or our qualifications aren't allowing us to do something new. So we don't dare to do something new. And we don't have a plan. We're just drifting, day by day. My guest, Paul Novell, talks in this episode how he decided to live the life he wants to live. He left the semiconductor industry, a well-paid job at around 40, to pursue a more independent life. Already since 2006, his primary source of income is from investments. I discuss with Paul many investment topics. It's interesting to learn how Paul was maturing over the years, how he switched slowly from discretionary dividend investing towards quantitative and tactical asset allocation investment systems. Enjoy the show. Hello, Paul. Thank you very much for accepting my invitation to the podcast. Could you please introduce yourself and tell us a bit about how you started your adventure with the financial markets?
Yeah, sure. Well, first, thanks for having me on. Appreciate it. So my name is Paul Novell, and I am a full-time investor. I run the Investing for a Living blog, and actually next February will be 10 years since I started writing Investing for a Living. And I started out in investing since I was quite young, 18 or so, my first bond purchase, but I didn't do it seriously or full time till I left my first career path, which was engineering, in 2006. And at that point, I went back to university and got a degree in finance, and then started down the path of being a full time, professional investor. So that's how I got involved.
All right, thank you. I've noticed on your blog that actually we can observe how you were transforming into a quantitative investor. I mean, over the last several years, you became a quant investor primarily, and you are mostly using some systems and algorithms to make your investment decisions. Could you please explain how your investor's path looked like? I mean, how you were transforming from being, as far as I understand, a discretionary investor, discretionary trader, into to become fully quantitative investor?
Sure. Well, like you said, yeah, I basically started and was a discretionary value-oriented investor. Like many investors, I started, have a sort of a value tilt and started reading, all the classics, Benjamin Graham, everything by Warren Buffett and Peter Lynch and John Neff and all these great investors. So I had sort of had a value inclination and started that way. And so when I first started managing my portfolio, even when I started to do it full time in 2006, I was primarily discretionary. And then slowly over time, I started being exposed to just different perspectives on different approaches to investing. And then more importantly, I really started to understand the behavioral and the human part, and how we tend to fail. Humans tend to fail making a lot of decisions, especially in complex or emotional environments. So that's when I started my path and discovered behavioral investing and some factor investing, starting with momentum and other factors, and then sort of slowly became more systematic over time. And in sort of 06, 07, I can't remember exactly what year, Meb Faber published his global tactical asset allocation paper, but that sort of opened my eyes to systematic asset allocation. And on the quantitative side, when I first read Jim O'Shaughnessy's What Works on Wall Street, the earlier editions, second and third edition, those two pieces of paper and a book really opened my eyes to quantitative investing, and then I started right down the path, and shortly thereafter became 100% quantitative.
All right. And do you see also any gain in time that now you can devote less time to your investments because you have quantitative strategies? Does it work this way?
Oh, absolutely. Besides just being emotionally easier, and I think you get better results because you reduce the human component. But obviously, I have my blog and my newsletter, and so I spend a lot of time for quote unquote work to do that stuff. But me personally, for my personal portfolio, I probably spend 30 minutes to 60 minutes or an hour a month managing my portfolio.
Right. You are the guy who retired very early, at very early age. And let me talk a bit about this. Why did you decide to early retirement? And actually, at what age you retired?
Well, I don't like the word retired, but
right.
I decided back then it seemed like nobody understood, so I had to use the word retired. But I wanted to be financially independent or financially free, I guess, and be able to do whatever work I wanted, and not have to be part of, I guess, the normal path. I think it's more common nowadays, but back in 2005, it was a little bit less common. So I sort of tended to use the word retirement. So I was 38 when I left my career in the technology industry and decided to do something different. And I didn't know exactly what that was at the time, but I knew I was gonna work, quote unquote work, but it could be whatever I wanted, wherever I wanted. And that was the most important to me. I wanted to be independent on my own and be able to do what I did anywhere in the world, because personally, my wife and I like to travel. And so we were able to live in many places, and I was only able to do that because I sort of left the standard career path.
All right. By the way, I noticed that you worked at IBM, and I paid attention to that because I also used to work at IBM as a software engineer. And you mentioned also on your blog that you met people there who worked for the entire careers, and they lost the reason for being, and it was also a kind of a trigger for you. It had a significant effect on you. But I suppose that it's not only money what you need to, let's say, leave your permanent job, because as you said, you don't want to use the word retirement. What else apart from money is needed in order to become independent? Because it doesn't go only about the financial independence. It has to also take into consideration some other aspects. I mean, like social life, the health aspects, the mental aspects.
Yeah, absolutely. So I got lucky in a way. So I started my career at IBM in the PC division, designing PCs, and I got to work with one of the first groups that ever created the architecture of the PC. So that was an incredible experience. But a lot of those guys were IBM lifers. So they were at IBM for their whole careers. And, after 25 years, you get a little blue badge on your business card when people used to use those, 25, 30 years of service, et cetera. And then so while I was at IBM, I saw several of these gentlemen retire in their mid-60s or early 60s after their time at IBM. And unfortunately, quite a few of them during the time I was still at IBM passed away shortly thereafter, or I saw them coming by work all the time and not being satisfied with their retirement, so they were quite unhappy. So that really opened my eyes and sort of, I started asking myself, well, why did that happen? And well, they had no hobbies outside of their work. They didn't have the time to put into stuff outside of work. And so that stuck with me for since that point. I said, well, I don't want to let that happen to me, and sort of pursuing other avenues outside of your normal career path to keep yourself motivated and entertained and mentally stimulated is critical.
Right. You mentioned on your blog that you tried a couple of times to, let's say, leave your permanent job to retire. Why was that?
Yeah, well, couple reasons. I think, being involved in the technology business or any industry, you're sort of socially, seems to be in the modern world, you tend to socialize with those same people as well. And like most people, I worked a lot, I traveled a lot, so I was still involved and engaged with those people. And when I had left, I still had contacts in the industry, and they'd call every once in a while. Hey, I'm starting a new company. I'm doing a new startup. Why don't you come join me? And we'll IPO in a few years, and we'll make a lot of money, or that sort of talk. So I got convinced a couple of times to come back and help some friends. One started a technology company. One started a proprietary trading firm in Hong Kong when those things existed. So it was still, I found myself, I'm back where I left before, maybe a little happier, doing something different, but still back in the commuting to work and traveling and sort of. And so I shortly figured out that wasn't for me.
Right. Is there any recipe for a happy retirement? Because you have some experience now since you, let's say, cut off from the permanent job. So after having so much experience, do you see any, let's say, rule, any recipe to be happy during your, let's say, retirement?
Well, it's tough. It's a tough question, but I would say for me, it's been concentrating on several things in your life. There's not only the intellectual component or mental stimulation with what comes through work or a hobby, but the social interaction is huge. And part of leaving a sort of normal career path is you lose, like you mentioned, you sort of lose some of that. And so you have to work hard to reestablish those social connections in a different way, whether it be through your local community or a hobby or through groups. Or nowadays, there's plenty of ways to do that, and family and health. So kind of all those aspects are part of it. And financially, there is a recipe, to manage your portfolio to make sure it lasts. And that's a big part of that component, to make sure you have the confidence and you're not afraid of running out of money all the time, because that could ruin your happiness real quickly.
Right. So let's focus a bit more on this financial part, because as your primary theme on your blog is how to live off your retirement assets, could you please explain the idea of so-called safe withdrawal rate? Because this is very important, especially if you are not having any permanent job, you don't have any regular income, but you have to have some resources to survive.
So that happens more and more nowadays, where a lot of people now that retire don't have pensions like in the old days, or leave their normal career path like I did. You don't have an income stream, a pension or Social Security to rely on. So usually you're going to live off your assets primarily. And so there's this concept of how much can you withdraw from your portfolio per year and have that portfolio last for your retirement period. So, and that percentage rate is known as the safe withdrawal rate. And the rule of thumb has always been about 4% that you can withdraw from your portfolio every year, inflation adjusted, and have that portfolio last a normal retirement period, which is 30 years. If you have a longer retirement period, it wouldn't be the percentage wouldn't be as high. So that's where that concept comes from. An amount of money you can take out every year that will last you for a 30-year period, given historical rates of return.
Right. I understand. So if, let's say we would like to retire at the age of 55, and let's say that we need $3,000 per month to have a comfortable life, can we quickly calculate what amount we should have in our portfolio as a minimum before deciding to go for retirement?
Yeah, so $3,000 a month would be $36,000 a year. So 1/4%. So 25 times that is, let me do some mental math, about $900,000.
Right. Okay.
All right. So then you could take 4% of that would be $36,000 a year.
Right.
$3,000 a month, and you would inflation adjust that every year. And historically, that has lasted for 30 years. At 55, maybe you have a longer retirement period of 45 years, and you should probably use a rate that's less than 4%.
Right. But once we retired, there are some, let's say, emotional aspects, because we need to withdraw our money regularly, and we may start thinking, will it be enough for the next, 30, 40 years? How do you increase the chances of success when you are investing during your retirement?
Yeah, that's I think that's one of the reasons I started down the quantitative path and also started investigating more risk managed strategies. So, the standard portfolio approach, the standard wisdom is buy and hold. Over time, you build the most wealth. But that's sort of not true if you're withdrawing money from your portfolio. So the biggest risk you have in retirement is bad early returns. So your first 10 years of retirement are the most critical period. So if you have a bad sequence of events or sequence of returns in those early years, it can completely ruin that your 4%, your income goals. So that 4%, for example, comes from a very specific period of history. It's from the retiree in 1966. That's where that number comes from. That's the worst case figure. And so that retiree faced low returns for the next 10 years, but also faced high inflation. So their inflation adjusted income needs were increasing quickly from 1966 to 76, and then portfolio returns were not good. So they had the worst of both cases. And even that portfolio lasted for 30 years at a 4% rate. So that sequence of returns, those first 10 years, are critical. So what you could do is implement a more risk managed strategy like tactical asset allocation or things like that to increase your chances of success.
And what are your goals in terms of yearly returns and maximum drawdowns?
I mean, I run simulation. I really don't have goals per se. I mean, my financial goal, my goal is to have my portfolio, fit my life and not run out of money. And so I think especially as an engineer, we all do simulation. So I sort of model my portfolio between low rates of return, anywhere from, 2 to 5%, 6%, best case, worst case scenarios. So I kind of have an envelope, and every year you sort of update that path and see where you are, see if you need to make any adjustments, because you can always make adjustments. Part of the problem with the traditional safe withdrawal rate is it never envisions that you make any adjustments, but you can, if you see that you have a negative sequence of returns for the first few years, most people have the capacity to adjust their spending a little bit to make things a little bit better. So, but that's the only one drawback with the 4% rule.
And do you think, Paul, that everyone can manage or, let's say, invest his or her money without the need from professionals like, mutual funds? Because you do everything on your own, but do you think that every person can do that, or that some people, they have to use and the help of people working for, mutual funds or some other institutions?
I think there's people that like to and should have their portfolio professionally managed. There's so many great choices now. I mean, even if on the buy and hold approach, I mean, Vanguard, as just one example, has their personal advisor services, and for 0.3% a year, you get a globally diversified buy and hold portfolio. So for many investors, that's the best path. But for those interested, it's not a technical challenge. It's not of mastering. You're not, especially of an asset allocation approach. You're basically picking a set of ETFs and over time. And so it's not, the technical aspects are not that difficult. It's more the emotional component and the behavioral component. If you get freaked out by the latest Twitter feed, and cause some negative reactions, cause you to sell, maybe you want to look at having your assets professionally managed. And now there's some very cheap solutions. 10 years ago, it was quite expensive, but now, like I said, like Vanguard, buy and hold for 0.3% a year, it's tough to beat that. So I'd say it depends.
Right. I understand. I would like to talk with you a bit about dividend investing, because your core strategy at the beginning, when you were writing your blog, was dividend investing. Could you please explain the main principles of such an approach?
Yeah. So I started off in discretionary and value oriented. And as I was approaching a period where I was going to withdraw my portfolio, a dividend is an income stream, right? So that's always there, and it tends to grow over time. So that was sort of how I started, sort of my my early stages of financial independence. But over time, I learned from writings of people like Meb Faber and other guys, dividend is just another value strategy. And maybe it's not the best value strategy. There's other, why should we favor an income stream versus a capital gain stream when maybe capital gains are even more tax efficient, especially in your younger years? So over time, I sort of said, well, no, I just want a more of a value approach instead of just a dividend approach. But what's nice about the dividend approach, and a lot of older people, older investors like that, is you just have this steady check that comes into your portfolio every quarter or every month or whatever it happens to be. And that can reduce some of the emotional components of investing. People feel comfortable with having that, that income stream show up every month or every quarter into their portfolios and prevents them from making behavioral mistakes. But from a pure total return approach, there's better approaches than dividend investing, as I found out.
Okay. And are you still investing in dividend stocks? Maybe now not on the discretionary basis, but maybe using some quantitative models?
I personally do not use a dividend model anymore. I have a quant service that I offer for customers, and one of the strategies there is an enhanced dividend yield strategy, which was created by Jim O'Shaughnessy, the guy who wrote What Works on Wall Street. And it's just a value-based dividend approach and just quantitative update every month or every quarter, or every 6 months. I personally don't use that because being a younger investor, middle-aged now, but a lot of my assets were in taxable accounts. I didn't have many years to build up a tax-deferred assets. So the tax on dividends is an issue, and I'd rather have a more capital gains oriented approach that's easier to manage and more tax efficient.
Right. I'm asking about dividend investing because I noticed personally that some people seem to be very excited about the idea of dividend investing, and especially in a strong bull market, it comes easy to say that we don't care about the current price of our shares, of the price of stocks, because what matters is only the dividend we regularly get. But often it appears that these people apparently didn't experience yet any major bear market with their dividend portfolio. And I think that as human beings, we naturally are prone to overestimate our, let's say, pain threshold when all stocks on the market are falling. Would you agree with that statement that some people think that the dividend investing is easier than it is in fact?
Yes, absolutely. To me, dividend investing is no different. Like you said, people say in a bull market, it doesn't matter. The income stream is staying the same. Well, a lot of those dividend streams get cut also, as we saw in the 2007, 2008 financial crisis. And sort of there is, as dividend yields have gone down over time, asset prices have gone up, dividend yields have gone down, there is a tendency to chase higher dividends. And, then they're not as conservative anymore. And what happens to those portfolios is that in a financial crisis, those dividends get decimated and those stocks actually go down. The drawdowns are more on higher yielding stocks than lower yielding stocks.
And have you been on the market with your dividend portfolio during the 2008, 2009 market crash? Do you have any personal experiences here?
Yeah, I went through the 2000 bomb and the 2007 financial crisis. I went through both, and partially, and I made it through both and didn't get scared too much. And that was part of the reason for me to switch to quantitative investing. It was emotionally very painful, both of those. Mm-hmm. But in the first one, in the 99-2000, value investing did amazing. So my natural inclination as a value investor, I got lucky, right? Value investing had one of its best performance periods of all time coming out of the 2000.com blow up. And then 07, 09, everything went down. So that was quite painful. Yeah. But yeah, so it was just managing through that.
And do you think it's worth picking individual stocks, even if you are using for that quant portfolio, quant methods?
That's a good question. My opinion is evolving on that. I'd say the challenge is picking, or even as a quantitative strategy. So, for example, my quant strategies, I have maybe each one is maybe a 10 stock strategy, and I have a portfolio of those. So, you're managing, even though it's automatic, and I try to automate it that we'll talk about later. But so you can be managing 30, 40 stocks in a quant strategy. An ETF-based strategy, a tactical asset allocation strategy, is way easier to manage. And now there's so many types and flavors of ETFs that you can express a similar opinion, or you can chase a similar return and drawdown goal by using ETFs. So, for example, a momentum strategy in ETFs, if you wanted to a similar return profile and drawdown profile to a risky quant strategy, well, maybe you could just use leveraged ETFs. And it's way easier to manage, and maybe has a similar return profile and drawdown profile to a quant strategy. So it's becoming a little blurry. And so I use both. I still use both currently, but the ETF strategies I work on, they're pretty darn good. I'm like, well, maybe it's not worth owning individual stocks.
You called buy and hold as the biggest line in finance world. Could you please explain? Because some say that, of course, we cannot time the market, that buy and hold is best long-term strategy because there is a market, that the market is efficient and it's difficult to beat the market. So some people think that it's the best strategy we can think about. But on the other hand, you say that it's the biggest lie. Could you please comment?
Yeah, I may have not said that now. Yeah, I don't think it's the biggest lie in investing. But one of the things I was fortunate, or I just got to do when I left the workforce, is I tended, since I was my wife and I started RVing around the United States for a few years. And so I was hanging around a lot of older people. And so one of the things I saw, and when they found out I was an investor, they would ask me to look at their portfolios and such. And I found a lot of buy and hold investors. Most of the ones I talked to, maybe it was just that the older generation, weren't implementing buy and hold because they had emotional barriers to do so. So the buy and hold mantra, so the standard 60-40 portfolios, 60% US stocks, 40% bonds, or even a globally diversified 60-40 buy and hold portfolio, I found most people were not anywhere near close to that because they had these emotional barriers. So maybe a portion of their portfolio was 60-40, but then they had these huge amounts of cash. And that could have been an effect of the post-financial crisis as well. So overall, they weren't implementing what buy and hold said they were. And so I was upset one day, and that's why I said that buy and hold. But I think for wealth building, if you have the emotional tolerance, it's hard to beat a globally diversified buy and hold because the markets are in general efficient. But there is certain factors that over time, or certain strategies that over time have proven to give you better returns: momentum, value, quality, trend following. Over long periods of time, the data shows that they are pretty effective. So that's why. And when I combine that with the need to for higher safe withdrawal rates, then I think those kind of factors or trend following can suit a larger set of investors than are currently using those strategies today.
You wrote an article about investors being overloaded with information. Why is it a problem? Because it may be a bit counterintuitive. I mean, many people may think that because we have easy access to information, that's a good thing, not a bad thing. But you say that it's a problem. Could you please explain?
Yeah, we're not built evolutionarily, we're not built to process that much information correctly. We just don't have the skills. And so there's a lot of studies on that. If you look at behavioral investing, if you look at decision making under more information, there's a famous study on experts, right? The experts make poorer decisions than normal people sometimes. So we're just not built to process that much information. And nowadays we're more exposed to information than we ever have been in the past. I can't remember who said it, but I saw somebody make a great point the other day where 20 years ago, even 15 years ago, the advantage was to gathering information. So, if I grew up learning about investing, Warren Buffett would read all these annual reports, right, and spend time with the paper and the annual reports and going over all the balance sheets and all that. So getting quality information was difficult, and there was an advantage to that, and you got rewarded for that. Now it's the exact opposite. Now we have too much information. Information is super easy to get. And the more information we have, studies have shown that we make worse decisions with more information. So now the challenge is, as an investor, to limit information. So for example, to improve my emotional performance in investing, I consciously have strategies to limit information, whether it be blocking certain words on Twitter, whether it be not checking my account balance only a certain frequency at a time. So I think as an investor, unless you're not going to look at your phone or your computer or the TV or and such, you have to actively have strategies that limit information and only let through quality information. I think that's a huge change in the last 10 years.
Okay, Paul. Are you trying to focus the markets? I'm just laughing a bit because when you were writing a blog a few years ago, I think it was 2010, for example, I noticed your statement that your investment outlook for another 10 years is zero return for the S&P 500. I know it's easy to say now after that time where we are with S&P 500, but I'm just asking if you are trying to focus the markets, or once you have now the quantitative models, you just don't care. I mean, you just follow your strategy, you stick to the plan.
Yeah, I stopped forecasting, but people like to forecast returns.
Yeah.
The GMO famous 7-year forecasts, everybody, all the expected returns and all that. But I quickly learned after that it was a fool's game, and you accept what the market gives you and you stick to your plan. So, for example, asset returns or strategy returns have gone a little bit down over time, but it may go down in the future. But, if you stick to your plan, and you have these models that sort of is, momentum is going to outperform or value is going to outperform, et cetera. Just stick to the plan and whatever the markets give you.
Could you please explain what a behavior gap is? I just saw very interesting articles on your blog about that, and how to address such problems, because apparently behavior dominates investor underperformance. And also a myopia is a problem. So if you could talk to us a bit about that. Yeah,
there's all kinds of behavioral effects, biases on investing, myopia, anchoring bias, confirmation bias. They've been, sort of well documented. And sort of that leads to investors to make mistakes. So they tend to performance chase. Right, it's like the famous studies on mutual funds. Investors tend to buy the winning mutual funds, and those end up being the worst performing mutual funds over time. So there's this, Morningstar always tracks their investor performance, so it's dollar weighted performance versus what the returns of the fund were, and those returns tend to be lower than so the investor returns are lower than what the funds did. So investors are continuously chasing. And making those behavioral mistakes. So the way around that for me is an automatic investment system where you just follow the plan and spend your time designing the plan and implementing it instead of focusing about the minutia of what the economy's doing or the stock market's doing or who said what, etc. And just stick to the plan.
Right. Thank you for that, Paul. You mentioned already about value anomaly and also about momentum anomaly, but could you please explain what a market anomaly is? I mean, why also such thing exists and how to use it? I mean, how to build strategy on top of some market anomaly?
Sure. So the markets are supposed to be efficient, right? The efficient market hypothesis says so, but there's a lot of the actual data doesn't necessarily agree with the efficient market hypothesis, at least not the really efficient form of it. So there's these factors, these parameters that of stocks that tend to outperform the market over time, and they've been proven for as long as the market's been studied over all the different asset classes, and they tend to be momentum, value. I think there's now the original three were momentum, value and size, the size of the company, small company effect. Now there's 5 or 6, depending on who you read, quality, and the investment factor, etc. So these sort of parameters implemented. So momentum stocks tend to outperform the market over time. In fact, cheap stocks, value stocks tend to outperform the market over the time. So if you have a quantitative strategies that can pick those factors, choose the cheapest stocks or choose the highest momentum stocks over time, you have a good opportunity to beat the market. You may not. It may not happen. For example, value has underperformed for the last 10, 11 years. Its biggest underperformance, I think, in history. So it may not, and that may mean revert or not. But over time, over across asset classes, this is the best data we have that shows these factors can outperform the market.
And do you have any, let's say, favorite anomaly which you like personally?
Yeah, I think momentum is the strongest. Well, the data says so. It's not my personal opinion. The data says momentum is the strongest factor by far. So it's over 2x, 2 times as strong as the next strongest factor, which is value.
And could you please shortly explain the momentum so that if someone is very, not experienced, could understand what the momentum anomaly is?
Sure. There's many ways to measure it and express it. The most common one would be the highest performing stocks over the previous 12 months will tend to continue outperforming. So if you ranked, say at the end of the year, you ranked the list of the top performing stocks by 12-month return, and you invested in the top decile or the top 25, 50 stocks, whatever it is, you did that every single period, every quarter, every 6 months, every 12 months, usually it's every year in the strategies, you will tend to outperform the market over time on a risk-adjusted basis. So that's simple. That's just simple momentum. And there's many ways to express it. 6-month momentum. People do all kinds of they average the momentum. But that's the principle. The highest performing stocks continue to outperform.
So psychologically, it may be quite difficult for investors because basically we try to find, let's say, bargains on the market. We try to buy something cheap and sell it at a higher price. Whereas here we try to buy something which is already, let's say, the price already went up, and we then are going on the markets, which may be not that easy psychologically, I guess.
And maybe that's why it continues to work and why it's so powerful. Because it is, I agree, it's the most counterintuitive factor. And people have a lot of problems buying stuff that's at the highs.
Right. What do you think about short-term trading strategies? I mean, because if I understand you correctly, your approach is mostly, let's say, long-term. So you don't trade during the day. You just open a position and you keep it for weeks or months. What do you think about short-term trading strategies? And do you think that maybe long-term trading is easier than short-term trading?
Well, I definitely think long-term trading is way easier than short-term trading. I think part of the reason is just emotional. The more decisions, my personal opinion, the more decisions you're exposed to, the higher the opportunity is you're going to underperform. Now, some people are very good at it. I think it takes way too much time unless you can have an automated short-term trading strategy. But to me, I've tried them. I've tried a lot of them. But it's just not worth the time. I'd rather spend 30 minutes to an hour a month running a quant or a TAA portfolio than spending my time doing shorter term strategies. So I never implement anything that's within a month period.
Right. What do you think about some theories saying that ETFs will trigger a huge market collapse? And I just saw an article where Michael Burry claims that the passive investing boom has led to, as he calls, passive bubble that will end in tears due to a lack of liquidity. How would you comment such statement?
I don't know. I don't have a really strong opinion on that. I guess that's another thing I love about being a quantitative investor. It's okay. If it happens, it'll show up in price.
Right.
And the investment models will take advantage of that. Personally speaking, if I was a buy and hold investor, maybe something like that would cause me more concern. But for me, that's not, because there was a couple other articles rebutting his piece and saying no, even though he was right in the 2009 financial crisis, he's not right now, et cetera, et cetera. So you can read countering opinions on sort of any financial subject.
And also, I think that the fact that you're using ETF doesn't mean that you are a passive investor. I mean, of course you can be, but you don't have to. You may use ETFs as for example, you do with your quantitative strategies. It doesn't mean that you keep these ETFs for years in your portfolio.
Exactly right. And the trading data shows that most people don't hold their ETFs for long periods of time. So
the passive investing is not that easy as it seems to be.
Correct.
What do you think about? I have another statement now from Ray Dalio. His opinion that the system we are living in now is broken, and he believes that the world is approaching a big paradigm shift. I don't know if you saw his articles on that, and if you have any opinion on that.
Yeah, I read. I like to read his stuff. My opinion would be the same. It's like, I guess so. I don't think it's probable. I think in the first 2 points in his piece sort of contradict each other. But regardless, if it happens, it happens. Again, having a quantitative model, it's a bit. And if there is this massive, the system is broken piece, then nothing's going to help.
Yeah, of course. But again, I mean, do you think that once you are using a quantitative approach, then you don't really, I mean, you can just read such statements, but you just stick to the plan and you just try to do your job and you don't try to forecast what will happen.
Correct. Yeah. I mean, I find it interesting, intellectually interesting. I like talking about things like that, but yeah, it doesn't affect my investment strategies.
Okay. Because for these people who are maybe not so advanced, once you have a quantitative strategy, that means that it's a algorithm which says exactly what to do, either to buy or sell or to do nothing. So basically, there's no place for guessing. But what is a problem maybe is that there is always an urge to look for ways to improve our strategy, our model. And trying better ways of doing things can be worthy and profitable. But on the other hand, there is a trap called data mining when we try to model the market and we are trying maybe too hard. Do you have any experience here with that?
Yeah, I think every quant investor has a tendency to try to always improve the model and always improve the system. So it's one of the biggest risks because you're not worried about maybe market news and what's going to drive the market. You're implementing the plan, but you're always questioning the plan.
Right.
Right. So you're always thinking about, I need to redo the plan. And so I think there's things that you can do there. I tend to stick to only things that have worked over long periods of time. So, these factors that we talked about, momentum and value are the two most famous ones, low volatility or what have you. And that the data shows have worked over different regimes, over many different time periods. And in order to change that, then I need a lot of data. So, I mean, I didn't even start heavily implementing a lot of my quant models till I solved the actual portfolios trade in real time for quite a while. And I wouldn't change my models unless I need a lot of evidence to move away, even if it's a different expression of value. So as an example, in the last few years, guys like at O'Shaughnessy Asset Management have shown that price to book, which is the famous value factor, the original one, doesn't work as well and it has stopped working. That seems to be true, but I have a hard time just throwing it out and just not using price to book anymore as part of a value. I'd rather use a value composite and use several different value factors. So I think you need a lot of I guess to make my long story short, a lot of data to change what's worked over long periods of time. So I tend to try and stick with that.
So how do you deal with periods of underperformance? Because as you said, the value is maybe not that efficient as it used to be. But once you have a model, you're following this. How can we know if our model is broken and need to be refreshed or even maybe replaced by something new? Because we can be very disciplined in following our strategy, but maybe after some years it will happen that we will see that simply that strategy doesn't work, it's broken. Is there any way to know, shall we stick to the plan or shall we change to something new?
Yeah, that's also very difficult. And this bull market has proven to be very difficult for many quants. Like we talked about, value investing has underperformed for 10, 11 years. So I think there's a couple things you can do. I think number one is you have to have the right period of time to benchmark your strategies. I think, for example, if you only benchmark your approaches to a bull market period, it's probably not the best thing to do. So I tend to try and use at least a full market cycle, and secondly, to try to use an appropriate benchmark. So I think, for example, in the current bull market, using the S&P 500 as your benchmark for a quant strategy is maybe not the best thing to do. So, for example, if I'm using a value strategy, I may compare it to the value factor in general and see if my value strategy is outperforming. How is it doing relative to value? If I have a global strategy, then 100% S&P 500 is not the best approach as well. So two things: compare over a full market cycle, and try to compare apples to apples. For a TAA, trend following strategy, a lot of people like to use the S&P 500 as the benchmark. I think that's the inappropriate benchmark when you have a strategy that can go from risk assets to risk off assets, and maybe a globally diversified 60-40 portfolio is a better benchmark. So those are the two things I would say: proper periods of time, a full market cycle, and appropriate benchmarking. And that helps. It doesn't solve the problem, but it helps.
And do you think that using multiple strategies which are not correlated with each other also could help?
Yeah, that definitely helps. I definitely would not use one strategy. So even in the say trend following space, you could use different trend following type of strategies. And in the quant space, value, momentum, low volatility, for example, has been an amazing strategy over the last 10 years. So that's why I sort of also said pick the appropriate sectors to compare to. So if you look at a value strategy like shareholder yield, in the current bull market has done very well. Low volatility has done very well, even though value in general has underperformed the S&P 500. So breaking it down into individual components is quite helpful, and diversifying across factors and asset classes.
How about the complexity of the quant models? Because maybe some people who are not familiar with that approach may think that this is reserved only to mathematicians or programmers. You wrote in one of your articles on the blog to try hard not to overcomplicate quant investing and to focus on getting a few big things right and keep it sweet and simple. Could you please elaborate on that a bit?
Sure. Well, I think keeping it simple applies to any kind of investing, even buy and hold. I mean, I've seen some investors with very, very complicated buy and hold portfolios. So keeping things simple in general is a better approach. But now there's a lot of resources, so you don't need. So, for example, quantitative investing with individual stocks is a lot more complicated than a simple trend following strategy. So there is a ton of resources out there. You've had, Gary Antonacci on your podcast, some of the Alpha Architect guys. There's amazing resources out there that make implementing a simple tactical asset allocation strategy easier. Meb Faber has ETFs that do it. He has a lot of great resources out there to make it easier now. So it's not that difficult. You can even play with the data yourself, and it's not that difficult. Again, like I said earlier, the technical aspects of it aren't that more complicated. It's more the behavioral part. But even if it is, now there's resources that are relatively cheap that allow you to implement these strategies on your own without much work.
To have a strategy is one thing, quantitative strategy, but another thing is the practical application of the strategy on the market. Here the things like taxes, fees, replication, slippage. For example, if you are using your strategies, do you transmit your orders automatically or do you do this by hand, manually?
It's a big subject, and it's very important because implementation of any strategy especially the more complex it is, can be the pitfall for many investors, and especially in terms of slippage and things like that. So I try to automate everything. With some of my strategies, I can't because I'm dependent on some things that some economic factors that I can't automate in the trading platforms yet. But in general, I try to have everything done automatically. If I do need to do something manually, I do it always when the market's closed, never during market hours, to just limit my behavioral pitfalls. So yeah, I try to automate it as much as I can, and it's getting easier and easier to automate these things and to hit the theoretical results, because what's published in terms of closing prices and what you can actually get, fees, taxes, slippage, is not necessarily what you're going to get as an investor. But nowadays, with market on close orders and things like that, it's quite easy actually to hit pretty much the theoretical results.
So would you recommend because plenty of strategies are based on closing price, would you recommend to use market on close orders for that purpose?
If you can, I'm a big fan of market on close orders, because you can enter them, pretty much any time from when the market closes till the next day. They execute in the last 15 minutes of trade on the NYSE in an auction system, so they don't go through the dark pools, etc. And most of the time, you can guarantee you're going to get the closing price with no bid-ask spread. So it's only happened to me a couple times where I haven't gotten the closing price. So I think it's a great development. A lot of people aren't familiar with them. A lot of platforms don't allow you to do it, especially for foreign investors, I've noticed. So if you can, I would investigate it. It's been a huge change. You can program it into your trading tool, and it allows you to get, especially with zero trading costs now, you can get even closer to the theory, and you can implement it that way. It's not as difficult as it used to be.
So if I understood you correctly, you transmit your orders also automatically, not by hand.
Some automatically, some by hand, depending on what strategy it is. But as much as I can, I have either Interactive Brokers or TD Ameritrade. I have coded, conditional orders that, based on certain prices, will execute my orders automatically. Right. But sometimes I need to go in and set up the order the night before, or before the market closes. If this happens in the last X minutes of trade, send this order,
right?
And send this market on close order, for example.
And how many quant strategies do you use for your investments at the moment? I mean, if you can say the number.
Sure, I use about 6.
6 different.
So they're related, and they're all related, but 4 sort of individual stock quant strategies, and 2 tactical asset allocation strategies, which are mine, which are the ones I've created. So there's slightly.
But does it mean that every day you have to do something, or?
No, once a month.
Right. I understand. And are you maybe using some approach like Dual Momentum by Gary Antonacci?
So I use my own. So I've created my own strategies. I have my Economic Pulse newsletter I offer subscribers and stuff. But basically, I like Dual Momentum as my favorite simple strategy. And then very close to that are Meb Faber's GTAA. That was the original name, Global Tactical Asset Allocation Strategy, GTAA3 or GTAA6. So it uses relative momentum. They both use relative momentum and absolute momentum, as Gary talked about on your podcast. Meb Faber's just uses a different way to implement them, and Gary uses a different way to implement them. Mm-hmm. So I like the simplicity of Gary's approach and the sort of the absolute momentum approach, and I like Meb's approach in that he opens it up to more ETFs, so factor ETFs like momentum and value, where Gary's not a big fan of that, and he feels that just the overall asset class is good enough. And Meb dices it up a little bit more, so you get some momentum and value in there, for example, to increase the performance.
Okay, I will get back to Dual Momentum because I noticed a very interesting article on that on your podcast as application on the bond market. But before we will go there, what tools are you using for your quantitative model research and implementation? I mean, what kind of software packages or programming languages do you use?
Sure. So that's changed a lot recently in the past couple of years because there's been such an explosion of tools. But right now, so for the tactical asset allocation, which is all ETF based, for my personal research, I use R. I learned how to program in R. And so for when I need to do backtesting and studies, now I've migrated to R. If I need to show my work to subscribers or to other people, since I'm not a web developer and I'm not that familiar with that, there's a great tool in Google Sheets. With Google Sheets and JavaScript, you can pretty much do anything that's related to ETFs. So there's great APIs out there from a lot of financial data services. Tingo, Yahoo has an API. Quandl has an API. So you can, if you learn how to access these APIs, you can access them through JavaScript. And so I write code in JavaScript, and you can plug all that data directly into a Google Sheet, and you can publish a Google Sheet to a web page automatically. So I don't need to be a web programmer in order to do something very, very simple. So for my subscribers, I automate the data gathering and displaying of returns and what are the top ranked ETFs by using Google Sheets and JavaScript. And then for my personal research, just to always investigating the plan, I tend to use R. And then for individual stocks, it's more difficult. I would like to migrate to an R approach, but right now I use a professional tool, Portfolio 123, because you're accessing fundamental company data, valuation data and such. It's more complicated. So I'm on their site and I learned how to program on their system, and that's where I run my individual quant strategies. But it's a lot more expensive. And
they have some proprietary language there?
Yeah, yes, they do.
Okay.
It's a scripting language. Some people find it difficult. I didn't find it that difficult. I've been using it for 4 or 5 years now. And it just makes it easy to run the strategies there, and I can trade automatically from their platform. I can send orders directly to, for example, Interactive Brokers, and they have all my orders executed automatically. So that simplifies life a lot.
Right. What are the biggest pitfalls while modeling the markets, while doing the research and development, in your opinion?
Well, I think you brought one of the big ones up, data mining. It's hard to combat that, to stick with what works, because there's a lot of brilliant, smart people out there publishing great research every single day. And so I read a lot. And so what's valid, what's not, what process should I investigate next? So you want to do your research, you want to constantly learn and evolve, but you don't want to be constantly changing your system as well. So that's a challenge. And the second one would be just, as soon as you open your computer, you're just exposed to news and such, and just not reacting to short-term movements. And for me, short-term, anything less than 5 years is short-term. So if I see a strategy or a market underperforming, if it's anything less than, like now, international stocks have been underperforming for a long time, and so
right.
But I'm going to take that with a grain of salt. Over time, I do want to have a strategy has the opportunity to be exposed to international stocks. I'm not going to, not invest in them because of what's going on, but I'll implement a relative momentum strategy that keeps me away from them when they're not performing well. So little things like that, but not reacting to short-term data is a big one.
And do you think that the more data, the better? I mean, in terms of backtesting?
That's a tough question. In general, I would say yes, but with a grain of salt. I think the world, the economy, markets have changed. So I tend to take a lot of very old data with a grain of salt. So if you show me a strategy that worked from 1871 through 1929, I'm going to be skeptical about applying that out of sample to today's markets.
Right.
Just to use an extreme example.
Right. I understand. Okay. I'd like to talk a bit about investing on the bond market. And how do you see bonds? Because once you wrote on your blog that for you, the real risk of bonds is not providing adequate returns to keep up with inflation and taxes over long periods of time, a risk that is rarely talked about. Could you please comment on that? How do you see the bonds market?
Yeah. I have a soft spot for bonds. I started investing in bonds. My grandmother worked for a railroad company.
Right.
And I remember she actually got bond certificates and actually clipped what they called coupons. You actually clip them from the pieces of paper. So I have a soft spot for bonds, but they have a big risk. Their fixed payments are taxed at normal income rates, and at least in the U.S. anyway, taxed at normal income rates. And inflation is a huge risk to bonds because it reduces the purchasing power of that fixed cash flow, and it's not a company; they don't have a chance to adjust to that. So yeah, it's a risk, but they're a great diversifier. So especially government bonds, even though in all periods they tend to be the best diversifier away from risky assets. So that I think they have a piece in every portfolio, even today.
Right, but today
maybe not in Europe, but
with the interest rates, yes. But that's my question about the era of low interest rates. Or Europe is very extreme case, but even in United States, what do you think? And should we invest still in bonds in the era of very low interest rates or even negative interest rates? And historically, we were treating bonds as a safe haven. Do you think it still is valid?
Yeah, those are tough questions, but I would say yes. I think there's a role of bonds for any portfolio because if you look at correlations between asset classes, when bonds earn their place in their portfolio tends to be when in risk-off environments or risky, like financial crisis, recessions. So if you look at conditional correlations when in bull markets, things tend to be kind of diversified. In risk-off, risky markets, all correlations tend to go to one, except the safe asset or the safer asset, if you want to say it that way. And U.S. Treasuries has been traditionally a good risk-off assets during those times. So they still serve an important role in a portfolio as a diversifier. And they also dampen portfolio volatility. And with rebalancing, you tend to get a decent return. Now, going forward, that's going to be less. The best predictor of a bond's return is its current yield. So, if today's at 2%, 10-year yield, 1.9%, I think they are recently in U.S. 10-year yields, one of the best in the world. The forward 10-year return is probably going to be about that. So, there's other things like credit bonds and things like that that are a little more risky. So that's one of the reasons overall portfolio returns are going to be lower in the future, because at least a portion of that 60-40 portfolio, that 40% is going to have lower returns. It's already priced into it. Now whether they're still a safe asset, I think they're still treasury bonds in countries with sovereign currencies should still be considered a safe asset. Yeah, I still think so.
Right.
The safest asset, anyway.
And do you have any experience with the so-called defined maturity ETFs? Do you think that such instrument can be helpful in the rising interest rates environment?
Yeah, there's ETFs or closed-end funds or mutual funds that in the bond space that are defined target maturity, like a 2022 bond fund. So the effect of that is just its short duration, and the shorter duration, the less effect on the bond price it has. So duration is just the change of interest rates, the change in the bond price for a 1% change in interest rates. So the shorter the duration, the less effect it has. So you can shorten duration and have less effect in rising rates, but rates may not rise, and therefore you're not going to get very high yield. So there's a drawback as well.
Gary Antonacci mentioned that he's using also his momentum model on the bond market, and you put a nice article on your website where you explain so-called global bond momentum strategy based on dual momentum. Do you think it can be a solution to our times in the event of rising interest rates? And could you please explain the overall idea behind that strategy?
Sure. Well, the strategy is it's just applying momentum to the bond market. And like I mentioned earlier, momentum works across all asset classes. So you just take in my strategy, for example, I just take 6-month 6-month total return, and you rank a series of bond ETFs by 6 months total return, and you invest in the top 3, and you do that once a month, and it has beaten the bond index over long periods of time. It's been tested back to prior to the 1970s, so it has a good track record. And as far as rising rates, it has done in the short periods that we've had some rising rates since the 1970s. It hasn't been many.
10 years.
Right. But it's done, it tends to, in the limited data that we have, it tends to, the bond momentum tends to outperform the bond index by more during the rising rate environment than the falling rate environment, because it tends to shorten duration as rates go up. Because the longer duration bond funds will perform worse. And so it's going to start buying the shorter duration bond funds.
Right.
And if rates aren't rising, for example, often when rates rise, high yield bonds still tend to do quite well because they're shorter duration. And so you can still get some outperformance there. So the latest example we had was from, I believe, 2012 to 2016. I can't remember. We had a period of 2.5 years or so where rates doubled. The 10-year U.S. Treasury yield went from 1.5 to over 3%. So in my article on my blog, I have that period, a specific period called out, and you look at the difference between the global bond momentum and the buy and hold index, and it outperformed by more than what you had during a falling rate environment. So I think it's just a good approach to having a factor automatic strategy in bonds instead of having to pick, am I in short-term bonds? Am I in long-term bonds? Am I in, high-yield bonds, freaking out about corporate defaults, etc. Again, just having this automatic strategy in bonds where it buys what's tends to have been performing well, tends to work over time and has done quite well.
Right. Yeah. The some problem with bond market is that, as you mentioned, for almost 4 decades, the interest rates were mostly falling. Therefore, there's not so much data to test how the strategies were working at the level of very low interest rates. And as you mentioned, yeah, you
have to go back and sort of manually construct. You can do it. I've done the analysis. You can go back and get treasury data and municipal bond data and some corporate bond data back to 1940. And so from 1941 to 1980, 1979, I can't remember when the peak in rates was. I think it was 1981. So from 1940 to 1981, we had 40 years of rising rates.
Right.
So you don't have access to all the bond asset classes, but even during that period, medium duration, so like say a 10-year bond, tended to do better than even the short-term bond, which is kind of counterintuitive, and obviously did way better than the long-term bond because you have that current coupon that you're reinvesting over time as rates go up. So it's not just the current yield, but the reinvestment factor that you have to consider as well. So we have some data, but not a lot of data.
Right, I understand. But still, do you think that this period from 1940 till 1980, 81 actually, do you think that this period can, let's say, imitate somehow the period in which we are now, if we will assume that the interest rates will at some point start growing?
I don't know. I would say no. As an automatic investor quant, I would say no. I have my model and I'm going to stick with it. But if you ask me I'm some sort of an economy junkie, and so I don't think the economic conditions exist for a rate rise to be that protracted and severe. The current level of asset and debt in the world won't allow a level of rapid rate rise like that before something really breaks. And if something really breaks, then rates go back down. So, but anyway, that's my fundamental view, which I try not to apply to my quant strategies.
As Mark Twain said, the history doesn't repeat itself, but it often rhymes. So maybe that will...
Absolutely.
Yeah. I have some final questions. What was your best lesson you learned in the markets, Paul?
The best lesson I learned was being exposed to learning about automatic investing, quantitative investing. And I stumbled across some great resources, not early on per se, so 14, 15 years ago, that opened my eyes to what was possible. So the discovery of mechanical investing, whether it be tactical asset allocation or even mechanical buy and hold investing in, risk parity or whatever it is. But that approach to not being active in markets and using an algorithmic approach to remove the human factor was by far the biggest lesson I've learned in the past 15 years.
Okay. And what would be your best trading or investing advice?
I would say learn about quantitative investing, at least tactical asset allocation, especially if you're thinking about or entering a period where you're going to be withdrawing funds from your portfolio every single year, where the sequence of returns matters a lot. Then, familiarizing yourself with, Gary's approach or my approach or Meb Faber's approach, and finding a model that works for you, or even they're using a professional like the Alpha Architect guys or the Resolve guys. There's some great resources out there. So that would be my single best piece of investment advice, and read about it. There's some great books about quant investing, momentum, and things which will help you along the path.
And which books or blogs, podcasts, or other materials, educational materials you could on investing you could recommend? Yeah,
well, the ones that got me started are still there. So anything that Meb Faber writes in his books are well worth your time. In his papers, his original tactical asset allocation paper from I think 2006 was groundbreaking. In the quant space, individual stock space, O'Shaughnessy, so Jim O'Shaughnessy, right, who wrote the book What Works on Wall Street. To me, that's the Bible of quant investing. Gary's book, Dual Momentum, is a great introduction to a very simple, effective system that anyone can apply. So those would be the big ones to me. And a book that made a big impact on me, which it's an old book in the mid-'80s, but I didn't discover it till later, was Winning on Wall Street by Martin Zweig. Martin Zweig is a very famous investor. He's no longer alive now, but he called the 1987 stock market crash. That's what he was famous for. But he, to me, was the original quant. If you go read his book, you'll see a quant strategy that he was using in the mid-1980s. But he wasn't called a quant back then. So that was a very influential book as well. And then all the blogs and Twitter from all these guys like Alpha Architect and Resolve, Newfound Research, O'Shaughnessy, Gary, etc.
Yeah, Meb Faber, by the way, also has a very great podcast.
Oh, good point. Yeah, podcast. He has one of the better podcasts. Good point.
Right. Okay. Thank you very much for all your information you shared with us today, with your knowledge. Actually, I just scratched a bit your knowledge, but I'm very grateful you shared all these things with us here. Is there anything else you would like to add before we will end up?
No, I think that's about it. Thanks for having me and letting me talk about the last 10 years.
Right. I need to tell you that I just read the whole blog from the first to the last article. I mean, your blog, and it was really a great pleasure. And I just could see how you were evolving, the whole process, how you were growing on the market. It's just a great experience. And I think it's also a good advice for anyone to write. So then after some years, we can see how we are progressing. So that's what I noticed on your blog, and it was a great experience.
Yeah, you bring up a great point. Writing has been a big part of my self-improvement. It's allowed me to become a better investor. So I agree with that.
Paul, thank you very much for your time. I appreciate a lot everything you talked here, and all the best. Thank you. Bye-bye.
Thanks a lot, Jack.
Thank you. Bye.